Well, welcome everyone. Welcome to Office Hours with Michael Kitces. So for this week's Office Hours, I want to talk about this blockbuster announcement, M&A announcement of the week, that private equity firm Hellman and Friedman is buying Financial Engines and taking it private for a whopping $3 billion in cash as a purchase. And perhaps more importantly, from the advisor perspective, we'll be merging mega RIA Edelman Financial, of which Hellman already owns a majority stake that they bought back in 2015. We'll be merging Edelman Financial into Financial Engines, which is a big deal, not just because Financial Engines got bought for $3 billion and has an estimated $169 billion of assets under management in the 401k space, but also because Edelman Financial itself has $21 billion under management and is one of the largest independent RIAs in the country, almost 35,000 clients of their own for whom they do investment planning and financial planning. Investment management and financial planning. Which means, in essence, Hellman and Friedman just brokered this massive deal to pair together one of the largest players in managed 401k accounts with human financial planners from Edelman at a size and scale that a few others besides maybe Fidelity have even attempted. And that's not only a big deal just as an opportunity for Hellman and Friedman, but it portends of what I think are some really interesting trends underway in the broader world of financial advice and how consumers get financial advice that I think will impact the financial advisor community for a lot of years to come. First and foremost, though, I think it's worth recognizing what a brilliant deal it really is for Financial Engines to be merged in with Edelman Financial. So from the Financial Engines perspective, this is an opportunity to add a new, higher financial advice service tier for its top 401k clients. In a world where reportedly Financial Engines is only charging between 0.2 and 0.6% for its managed accounts, but Edelman's fee schedule starts all the way up at 2%. Now, to be fair, that's what Edelman charges for individual retail consumers who come one at a time. I suspect that if Edelman Financial is going to get, call it, distributed as advice through 401k channels with big enterprise level deals, that fee is probably going to come down a little bit. But the point remains that the pricing power for human financial advisors much stronger than just managed accounts, great technology, and robo advice. And I think this was the strategic vision that Financial Engines tipped off a couple of years ago when they bought the mutual fund store in 2015 and added 125 physical branch locations with local human advisors, which is a big deal because Financial Engines is often been referred to as the original robo-advisor, since they've been primarily a technology-driven managed solution to help with 401k plans going back to almost 20 years. And suddenly the OG robo-advisor bought 125 in-person branch locations with human financial advisors. That is a big strategic shift for Financial Engines. Now, there's some debate out there as to why Financial Engines has taken the next step with Edelman and all of its advisors in locations across the country merged in. So when the news originally broke, I tweeted out that it seemed like Financial Engines must have been so happy with the results of the mutual fund store that they wanted to scale it up with more advisors. Buzz I'm hearing since then is that what may have precipitated this was more that mutual fund store advisors didn't go deep enough with their advice, was primarily a retail investment solution at the end of the day. They were not a provider of comprehensive financial planning. And that Edelman Financial gives Financial Engines kind of the deeper financial planning chops, the greater depth they need to really add a meaningful advice layer on top of what their managed accounts provide for an additional advice fee. Either way, though, it still emphasized the point that even the biggest player using technology in the managed 401k space sees its future as layering more human advisors as a value add on top of the technology, not as a replacement for human advisors, which I think is a pretty resounding victory for the future of human financial advice. From the Edelman Financial perspective, though, this deal also looks like a huge win to me because the magic question for Edelman Financial for years now has been, how will Edelman grow without Edelman? What happens when Rick retires? And while the company has been trying to diversify its marketing strategies for years, most of its growth and success over time has been anchored to Rick's books, Rick's radio show, Rick speaking. So what happens when Rick finally retires and isn't there to drive the marketing effort anymore? So the answer? Give Edelman Financial an opportunity to be distributed to 1 million clients that Financial Engines already serves, which is about 30x the size of Edelman's client base. So to put it mildly, there's a whole lot of growth now that Edelman Financial can get through Financial Engines, just crossing over financial advice to existing 401k plan participants. and it doesn't need Rick to do that in the same way that it did in the past. Of course, not everyone in the 401k plans will want or need a financial advisor or be able to afford it, but it's important to note that Edelman Financial has always actually been the mass affluent wealth management firm. They are not focused on the high net worth space with $1 million plus account minimums like so many other large RIAs. Instead, Edelman has about 35,000 clients and 21 billion of AUM, according to their ADV, which if you do the math, is an average client size of just under 600,000. And that's after a 9-year raging bull market lifting up their account sizes. So just a few years ago, their average was just about $400,000 per client household, which means there should actually be a pretty large base of more affluent financial engines clients who would fit well with Edelman's financial planning solution. Not all financial engines clients, but a whole lot of them when Edelman already successfully delivers planning to the mass affluent at a pretty considerable scale with 35,000 clients. And so Edelman brings the chops to financial engines to really learn how to institutionalize financial planning and bring it to market at scale. Again, because Edelman's firm is already one of the largest providers of human financial planning advice at scale. And now they get this opportunity to grow at many multiples larger, expanding into the financial engines client base. So, my guess, financial engines and Edelman get about 5 to 7 years to grow in this new merged thing. And the ultimate goal is Hellman and Freeman probably wants to re-IPO the combined entity at a much larger size and a much, much larger revenue base back into the public markets, as all these human advice services provide a higher tier solution for the 401k client base at a higher price point, which gets both a good ROI for Hellman and Freeman and ultimately gives Rick Edelman the victory of actually building an independent advisory firm from scratch that culminates in an IPO to become a publicly traded company, which I think is not just an absolutely amazing achievement for Rick, but really for the entire independent advisor community. It puts financial advice on the map in a new and different way when you can take a financial advisory firm from scratch in an independent model and IPO it in public markets. From a broader industry perspective, though, I can't emphasize enough the significance that the company that was arguably like the OG original robo-advisor has been buying a series of human advisory firms. First Mutual Fund Store, now Edelman Financial, to increasingly sophisticated, to deliver this increasingly sophisticated human financial advice to their robo clients. Now, the trend isn't unique to financial engines. We've been seeing it happen all across the robo-advisor space as their organic growth rates have been declining. So a huge number of the original robo-advisor solutions competed against human advisors and have now pivoted to be technology platforms for human advisors. So BlackRock bought Future Advisor, SigFig partnered with wirehouses, Vinar Nest Egg pivoted to become Advisor Engine with money from Wisdom Tree, Invesco bought GemStep for advisors, et cetera, et cetera. And we're seeing now the next generation crop of, call it like B2B from the start solutions that have emerged more recently, like Robust Wealth and Next Capital. And then, of course, there's the fact that even Betterment launched a human advisor premium solution last year. And the reason this is significant is that it's not just that technology really is being proven out as a means to augment human advisors more than compete against them, which was something I've been predicting back in 2012 when the current crop of robos showed up, but also that the robo-advisor price point isn't likely going to be the actual endpoint for financial advice after all. Because the real fear that cropped up in the advisory industry when robo-advisors first showed up was not just, oh, geez, they have better tech, we're all screwed, consumers are going to pick robos or anything like that. But there was a lot of fear of, oh my God, are fees going to actually go down to 25 basis points? I don't think I can compete. I don't think I can run my advisory business with a fee schedule of just 25 basis points. Except what the robo-advisors now learning is that financial services, sadly, is such a low-trust business. Consumers don't automatically just buy the lowest cost solution. Instead, they start wondering if something is hidden to make it a low-cost solution, or they assume that lower cost equals lower quality. Not always the case, but a common fear. And moreover, I think the robo-advisors still fundamentally misunderstood what human advisors actually do to add value. The robo-advisors thought that all we do to get paid 1% is asset allocate a portfolio, which they said they could do with technology for 25 basis points instead. And what they're actually learning is that clients want to pay for that advice relationship. And we already had technology that minimizes the time we spend creating asset allocated portfolios. It was only ever a small percentage of an advisor's time for a decade or more now. We've had rebalancing software for 14 years. It predated Betterment and Wealthfront. And so what's really happening as a result now is robo-advisors are struggling to find profitability and scale at their 25 basis point price point and are increasingly trying to add human advisors on top to deliver more value and charge more as a result. Or stated more simply, the initial fear when robo-advisors showed up was that humans charge 1 and robos charge 0.25, and the humans were going to have to capitulate down to the robo level. And instead what we're finding is the robo-advisors who are capitulating up to the human advisor value proposition and then trying to price themselves back up because it wasn't the 1% human fee that was wrong. It was the 25 basis point fee for robos that was actually wrong and not working. And thus, I think why Hellman and Friedman sees this mega opportunity to merge Financial Engine's robo solution into Edelman Financial's human advisor. So Financial Engines can have a higher tier service and charge more for human advice to get paid more in advice fees. Now, to be fair, I don't necessarily think this means all robo-advisors could come all the way up to the 1% fee, because their technology probably does mean they can run a 1% fee model at something a little less than 1%. The case in point example is probably Personal Capital, which gets branded as a robo-advisor, but it's really not. It's all human financial advisors. They're mostly based in Denver. They use technology to augment the human advisors, and they don't charge 1%. They charge 0.89. So they're a little lower. Technology efficiency helps. But that's less about like fee compression and simply the recognition that firms better using technology for efficiency can charge a little less and still maintain their profits because the technology just makes the firm more efficient. So it's easier to charge a little bit less and still be as profitable as they were. That's what happens when technology augments humans instead of replacing them. All that being said, though, I think the biggest trend actually portended by this Financial Engines Edelman Financial deal is the one that the industry has missed so far. And it's that the rise of human financial advice solutions directly in the 401k channel, as Financial Engines is going to offer through Edelman Financial, may mean the beginning of the end of the giant 401k rollover bonanza that powers so much growth in the advice business today. Which matters because the industry data is pretty clear. The overwhelming majority of advisors serve baby boomers who are approaching retirement are already in it. And we do that because that's where the money is. The people who have had the longest time period to accumulate their wealth tend to have the largest portion of it. So baby boomers who are at the tail end of their careers tend to have the largest pile of assets, which is where most advisors focus when most of us are in the assets under management business. But historically, defined contribution plans like 401k plans were self-directed. So consumers both accumulated their wealth in a retirement plan and didn't have an advisor to help with it, which meant that the act of retiring was both a money in motion event. Financial advisors have used for 30 years now the defined contribution movement to grow their businesses because it put big dollar amounts that retirees spent decades accumulating in play all at once for a prospective retiree who probably never had an advisor to help with that money up until that point. That's the incredible opportunity. That's why there's so much focus on retirement rollovers from 401k plans, and it's driven a lot of success for retiree-centric advice firms over the years. Until Financial Engines merges with Edelman Financial and starts offering human financial advice in the 401k channel to 1 million plan participants, such that by the time those people are getting ready to retire, they may have already had an Edelman human financial planner for 1 or 3 or 5 or 10 plus years. And they don't need to find a new financial advisor to roll over to. They just continue with their current Edelman advisor after they retire. And that entire market opportunity for independent advisors to grab all these 401k rollovers from unaffiliated consumers that didn't have an advisor begins to vanish. Now, you may be wondering whether this creates conflict of interest issues for firms like Financial Engines and Edelman. I don't think it actually does, because what's going to happen is that Edelman Financial will offer advice to the 401k plan participants while they're still in the plan. I don't think it's just about grabbing the rollovers. It's in the plan. So whatever Edelman Financial ends up charging for its human advisors in that higher volume 401k space, the ones who want to pay a higher advice fee for advice will already be paying their Edelman advisor. So what happens when they retire and roll over their assets? Nothing. They're already paying the advisor. They'll just continue to pay the advisor. There's no fee differential. There's no conflict like, hey, roll over to us so we can make more in the outside advice fee than we made in the 401k plan. The same fee they're already paying will apply because it's the same advisor on both sides already providing that value-added layer. They'll simply move from a Edelman advisor helping with a financial engine's managed account, the 401k, to an Edelman advisor probably giving a financial engine's equivalent managed account in an outside an outside IRA for the same fee, for the same ongoing advice, for the same managed account solution, with the same investments, which means there's no conflict of interest for all those 401k clients already working with an Edelman financial advisor. Now, to be fair, the shift isn't entirely new. Companies like Fidelity have long been trying to offer more advice and managed account services in the 401k channel in the hopes they can deepen that relationship with the 401k plan participant and have them stay at the firm. For Fidelity, that historically meant just trying to get them to roll over from a Fidelity-administered 401k plan to a Fidelity-administered IRA. But I think even Fidelity wants to go deeper. I had predicted this years ago when Fidelity bought eMoney that it wasn't just about serving the advisor community with this financial planning software they bought that's popular with RIAs and broker-dealers, but that eventually that eMoney dashboard would be offered to every Fidelity 401k plan participant out there to track their own financial well-being. And then when they were ready to retire, they just get this message that says, did you know you can already go to any one of hundreds of Fidelity branches and talk to a CFP certificate who can give you retirement advice on the spot? Because the 401k participant already linked their accounts to eMoney, which means that Fidelity branch advisor can do financial planning on the spot. There's no data gathering. It's already in the software. And the branch advisor just starts giving advice on the spot. Still, though, Financial Engine seems to be taking this to a whole other level because it looks like Edelman Financial won't just be there to give advice to Financial Engine's participants who are getting ready to retire and roll over. It may be offered to them directly while still working. That's the game changer, which means they'll already be advice clients before rollovers are ever on the table, which means realistically, most of them will probably just continue to be the same advice clients for Edelman when the rollover occurs. And that, I think, is the biggest part of this Financial Engine's Edelman Financial deal. Sure, the financial wellness trend has been out there for a while, offering some financial education to 401k plan participants and as a way to charge 401k plans a little more to provide an additional service. But layering in a higher tier service, full-scale financial planning from Edelman advisors, that's the game changer. Because it's a new distribution channel for human financial advisors, which is why it's so great for Edelman Financial, because it allows them to grow without Rick in the future. But again, this goes beyond Edelman Financial. This has the potential, I think, to change the whole independent advisor space as well. Because if most consumers end up getting their financial advisor and paying for their financial advisor directly through their 401k plan, long before they ever get to retirement, Edelman advisors just keep serving them in retirement. And the only way advisors now start winning clients away is niches and specializations that pull them away from their existing Edelman advisor. So I hope that helps a little, some food for thought, and perhaps a unique take on the big news about Hellman and Friedman buying Financial Engines and merging Edelman Financial into it. This is Office Hours with Michael Kitces. We're normally 1 p.m. East Coast time on Tuesdays. Obviously, I'm traveling this week. Investment News' Retirement Income Summit, a MOCAN Trust Conference today, Philadelphia State Planning Council tomorrow, so I had to squeeze this in from the hotel room while I could. But thanks for joining us, everyone, and have a great day.